Something I've noticed, and I kind of want your guys' opinion on this. It seems like nothing really happens in markets for like a week or two at a time, and then every time there's like a CPI or there's a Fed meeting or unemployment data, that's when all the action occurs. Have you guys noticed the same thing?
Yeah, I mean, I think just generally speaking, that's a lot of how markets operate, and in bull markets are a little bit different. But certainly in the bear market, and there's a lot of reasons for it. I think from a traditional price action standpoint, you kind of need to see these compressions of volatility before you can get a big move. It's kind of just this. Buildup of positions, people get tired, volume dries up, and then you kind of see these big explosions of volume and volatility and price action. And then on the other side, it's kind of a lot of the trading is algorithmic. So like something around 70% of all trading volume is algorithmic, and a lot of these algorithms are based off of news cycles and scanning news, and they're looking for what actually happened with economic data points versus what was the team at whatever fund expecting to happen. And that can cause a reaction and obviously drives a lot of liquidity into the market. So you kind of see these big explosions of volatility kind of around those big events.
That makes sense. I didn't realize 70% is algorithmic. That's insane. I had no idea it was that high.
Yeah, it's very high, but and that's kind of one of the arguments that people like to make against using technical analysis and things like that. Saying that it doesn't matter because or like studying human emotion doesn't matter because most of the volume is algorithmic. I would say the counter argument to that is these algorithms are built by humans, so by understanding humans, you can understand what these algos are looking for. And also, a lot of these algos are based off of technical indicators. So they're looking to buy at a certain moving average. They're looking to sell at a certain moving average, or they use volume weighted average price, or all these different things that algorithms use as well. But yeah, it's definitely interesting.
For sure. I guess you can go ahead and get the ball rolling, Blake. And I assume you want to kick things off with a little discussion about CPI.
Yeah, you guessed right. So kind of start off the newsletter just mentioning essentially what you were just bringing up, Mitch, is that we had a sideways couple weeks, and we essentially had a sideways December, in a lot of ways, at least in Bitcoin, for sure. But and we kind of saw this explosion of volatility this week coming alongside or just prior to the CPI announcement yesterday morning. But we kind of saw this run up leading into it, and then obviously we saw heightened volatility intraday yesterday, and then today, we're relatively flat or so on the indexes. But just as a reminder, I doubt anybody listening really needs this reminder, but just in case, last month or November's headline CPI came in at 7.1% year over year. That was released in December, and 0.1% month over month. Now December's numbers, which is what we got yesterday, came in at 6.5% year over year and negative 0.1% month over month for headline, and 5.7% year over year growth and 0.3% month over month growth for core. All four of those numbers were in line with market expectations. And I think, the big one that the market's focusing on, obviously, is the negative 0.1% month over month growth for headline CPI. And I think, just solely based off that number, it would appear that inflationary pressures are subsiding. But, at least for now, I think there's, obviously a lot of things that the Fed could do, that markets could do, that just the broader economy could do that would bring inflation back higher. But for the time being, it looks like, those inflationary pressures are subsiding. And we've talked about this in the newsletter and on these spaces for the last, I don't even know how long, month or so, maybe 2 months, kind of talking about this narrative shift that we're seeing in the market. And I want to harp on it again. And just kind of to recap is the narrative throughout 2022 was, obviously, most people would know this, is that this historically high inflation was being fought through tightening financial conditions. So, raising interest rates, quantitative tightening, things like that. But in recent months, we're kind of seeing the market shift away from that inflation narrative and moving towards this narrative surrounding this recession that could potentially be caused by this tightening cycle from the Fed. And this shift kind of initially started in mid-June or so, with dips in yields, signaling that investors had kind of believed that inflation had peaked around that 9.1% print that we got. And in hindsight, it looked like they were right. And we kind of saw the same thing back in October, where yields peaked again, kind of when investors kind of began to see this finish line in sight for the rate hikes. We kind of got a shift in the rhetoric from the Fed. But that rally in the bond market, and to recap, if you don't understand, a drop in yields is a rise in the bond price, which means there's more demand for bonds when you're seeing a drop in yields. So kind of what we're seeing now is that it looks to me that the fixed income investors are now kind of seeking recessionary protection of owning government bonds. And that was sort of the traditional narrative that we've seen from treasuries, is that they tend to outperform during recessionary periods because investors want to have their money tied up, right, and earn yield on it. But in a inflationary environment, that's not always the case, because inflation in the debasement of currency is devaluing those future cash flows. So what we saw is a huge sell-off in Treasury securities when inflation was the number one hot button issue and thing to worry about. But now that it appears that might be behind us, we're kind of seeing a rally in Treasury securities as people are kind of seeking that recessionary protection. And I think that theory is also supported by price action and other recession-proof assets. I'm using air quotes on recession-proof assets. But looking at gold's had a good past couple months, and also defensive equities like consumer staples have also performed fairly well recently. So I think the market clearly believes that a recession is coming, but whether you actually get one, or when that one comes, is obviously unknown, and nobody could tell you that. So now in the newsletter, I talk a little bit more about CPI here. I don't want to, harp too much on CPI. I think, you should go and read the newsletter. I think, we did a good one this week, looking at, month over month change to CPI. One thing that I do think is interesting, and I think is worth noting, and is comparing this environment to like the mid 2000s environment. And I don't obviously there's a ton of differences there, right? But I think just from the CPI perspective, it's pretty interesting to look at, especially from the month over month CPI perspective. Obviously, so the kind of time period I'm focusing on is like this 2005 to 2007 time period. And obviously you didn't see a 9.1% inflation or CPI inflation print at the time. But on the month over month basis, 2005 had a I can't even, what is it, like 1.4% month over month growth, which, so they were seeing a faster increase in CPI in 2005 than we even saw in 2022, which I think is interesting. And what we saw is that, in mid 2006, the Fed began to raise rates, and you started to see that inflation come down. And then they essentially held rates stagnant through, mid 2007 or so. And then when the Fed funds rate was lowered in 2007, it led to another spike in inflation that contributed to that 2008 financial crisis. So, like I mentioned, obviously a much different time period, and there's a lot, going into this market that wasn't as relevant in 2005 and vice versa. But I do just think it was interesting. It's a theory that a lot of people have about this 2022, 2023, 2024 type environment where, we've had high inflation, the Fed's raised rates. Now the Fed rhetoric kind of indicates that they want to just leave them stagnantly high for, maybe the remainder of 2023 and bring them lower, maybe towards the end of 2023 into 2024. And a lot of people believe that at that point, if that were to happen, you would have another spike in inflation. And I think it's just an interesting theory that, was worth discussing. But, I think the difference is that, the Fed rhetoric is, clearly indicating that they understand this, and that, that risk of bringing rates lower too soon is at the top of their minds. I just thought, it was worth interesting, or I thought it was interesting and worth sharing. There in the newsletter, we kind of pivot to talking about GDP. So looking at, the Q4 GDP estimates for 2022 from the Atlanta Fed, they're currently indicating that their current estimate is that GDP grew by 4.1% in Q4 2022, which I think is really interesting, because if now we're seeing month over month inflation become negative, and the big key there is that it's now negative, right? So you can have declining month over month values that are still positive, and all that says is that inflation is still rising, but that rate of increase is slowing. But now that we're seeing this negative month over month value, that means that inflation actually declined from last month. So this decline in prices would indicate a decline in demand, which would generally signal that there's going to be less economic activity. And if there's less economic activity to a high extent, you can classify that as recession. But we're also expecting to see, Q4 GDP be, fairly strongly positive, positive growth, I should say, which I thought is, pretty interesting dynamic that's going on there. And that, it's also supported by a fairly strong labor market. So I think, combining all those factors, I think it's, pretty hard to argue that the U.S. is currently in a recession, but, there's certainly a lot of indicators that we're headed in that direction for, 2023, 2024, something like that. Um, and I,
Blake,
yeah,
real quick before you get off that, how is that possible? How could we have pretty relatively high GDP expectations and also see inflation go down at the same time?
it's an interesting question. I think, GDP is a much larger metric, right? And obviously CPI is a very large basket. There's something like 80,000 different goods in the basket, and they're also weighted differently. But you can still see a increase in economic output if prices are falling, just because people are buying and selling goods at a greater extent, in production is still fairly high and unemployment is low, which means that there's a lot of people in the workforce at the moment. There's also a lot of people leaving the workforce, which is kind of the argument against that we really have low unemployment right now. But it's just that, aggregated across the United States, we're still seeing strong economic output.
Yeah, just add on to that topic. That's kind of like how could prices go down, but economic output go up? I feel like I think it's something called like Jevons paradox, where it talks about, hey, like if the price of energy goes down in half, maybe demand for energy doesn't just double, maybe it quadruples or goes up 10x. And that's something kind of along those lines of, hey, like we can get more productive as things get cheaper and cheaper. But yeah, great points by both of you guys.
Yeah, I get that point. That makes a lot of sense. But like I'm just confused because isn't the Fed's strategy here is to lower inflation by basically killing demand. You're it cause a recession, people are just not going to be able to afford to bid on goods, and that lower demand results in a lower price.
Yeah, I mean, one of the other things that we're seeing that I wasn't necessarily going to bring up in this space, but it's in the newsletter. But we might as well just talk about it. Is looking at debt levels right now. So kind of what we're seeing is that we've seen a decline to mortgage balances and new mortgage signings. Obviously, with high interest rates, and historically very high housing prices. But we're also seeing like consumer credit levels, which revolving consumer credit, which is just essentially mostly credit card debt. For the average American is at an all time high. So what we've seen is that the goal of the Fed, like you mentioned, Mitch, was to raise interest rates to destroy demand and eventually reach a point where your car payment and your house payment and your credit card payment are so high that you're electing to maybe not spend money doing other things, or you're electing to not buy like the name brand clothes or groceries or whatever. But instead what we're seeing is that as prices are rising and interest rates are also rising, people are just spending more money. And I think eventually it would reach a point where if interest rates are going to be held stagnant long enough or held elevated long enough, that eventually people are going to come to the point where they can't afford to spend more money anymore, and they actually have to start spending less. But at the moment it kind of seems like we're getting that shift, and that's kind of this disinflationary, if you will, type environment that we're potentially rolling into. Obviously, 1 month of declining month over month inflation does not mean that we're in a truly disinflationary environment, but it kind of reflects this idea that people are starting to elect to not spend as much money. Um,
That chart you got there about the credit card debt, I guess I'd seen that but forgot. But that's sort of fascinating, and it's almost, I don't know if this is accurate at all, but it seems like at the federal level, they're racking up so much debt over time, and it's like that behavior sort of just trickled down to the everyday person. It's like, well, if the government's got all this debt, then why can't I have all this debt? And also along with that, it's like comes with the whole debt forgiveness thing from a few months ago with the student loans.
Yeah, I mean that ended up not really working out too well, but I do think it to some extent it's kind of like a human instinct, and it's really been an issue of the last 50 years, right? Since we left the gold standard and the credit system and the fiat monetary system has kind of been let off the leash, if you will. But I think there's to some extent a basic human instinct to just take on more debt because it's a lot easier than working harder to make more money. It's a lot easier to just open up another credit card, and for the government, it's a lot easier to just, pass another bill funded by debt than it is to, raise taxes across the board on all your citizens. So, to some extent, it's easier to take on debt. And I think, that's kind of the reason why it seems to be at this, point in time in 2023, kind of a basic human instinct. I think it's just really interesting. So, from there in the newsletter, I kind of started talking about, asset prices this week. So first we're talking about the NASDAQ composite, looking at the equity markets. Obviously with the, CPI announcement comes heightened volatility, kind of what we were just talking about at the beginning of, this monologue, Mitch. But, we had heightened volatility intraday but the NASDAQ ended up closing, only up like 64 basis points or so, which, was interesting. We had a pretty big upside reversal there intraday to get above the 50-day simple moving average. And this kind of, strong price action has stemmed from last Friday. So, a week now. Last Friday, there was a 2.76% gain on the index on the NASDAQ. And it appeared to be that the market was pricing in this high probability of another period of subsiding CPI inflation. You're also going to have, shorts closing positions into CPI inflation. So I think that's kind of what we've seen this week is, once again, like we were talking about earlier, Mitch, like algorithmic trading, you're going to have, algos closing their short positions leading into a big, data announcement because, you want to avoid that volatility to some extent. And you're also going to have, an influx of, long traders coming in, prior to CPI and now after. And I think we kind of saw a relatively similar reaction in the Treasury market this week, where yesterday yields were lower essentially across the board. But these, inline inflation numbers triggered even more, buying for those longer maturity government bonds, like the 30-year, the 20-year, the 10-year, things in that neighborhood. So in the newsletter, I included the chart of the 3-month, 10-year yield spread, which is interesting because now it's, even further into negative territory. Yesterday, it closed at negative 1.23%, which is the lowest reading in, the history of, the spread that I can find online in the data. So, Fred or, the Federal Reserve economic data has it dating back to the 80s, and it's never been this low since at least the 80s. Which I think is, pretty interesting. And in the way that I'm looking at it is, kind of from 2 points. First, I think it shows that investors are continuing to prepare for recessionary conditions as inflation is falling. So that's what we talked about earlier, right? Where in an inflationary environment, you don't want to be holding long maturity bonds, but now in a recessionary environment with inflation subsiding, you want to be holding longer term or longer maturity treasury bonds. And then secondly, it kind of just shows that investors are expecting lower rates at some point in the future. So for now, it appears that the bond market was right about peak CPI over the summer in October as well. So now, the question is, are they right about this incoming recession? And I think, only time will really tell. So from there in the newsletter, we pivot to crypto equities. Joe and Mitch, if you guys had anything about that, feel free to chime in. But I could start talking a little bit about equities if you guys want, or crypto equities.
I do have a question about bonds. When you say, the bond market was right about peak CPI, and the Fed basically paused right after bond yields topped off, if my understanding is correctly. So is it that the bond market's right, or are people really just sort of making their move about after like seeing what the bond market does? I don't know. I'm kind of confused there.
Yeah, no. Let me try to explain it better. So in June is when we got the 9.1% CPI reading. So right around that time, you saw yields peak, which means that prior to that announcement, there was this massive sell off in the bond market. And I think that's where a lot of people can get confused is, we like to talk about yields, but, yields have opposite, price action, if you will, to, the price of the bond. They have an inverse relationship, yield and price. So if we just want to talk about price for the sake of simplicity, you had a massive sell off in the bond market stemming like starting in September or so 2021 all the way down into June of 2022. And then you kind of see this massive CPI reading at 9.1%. And the bond market essentially had called that this is probably going to be somewhere around the peak of inflation. So then you saw a rally after that. And the equity market was a little bit different, where it continued to sell off. And the bond market was rallying, kind of indicating that they believe that the worst of the inflation is likely behind us. And the bond market did continue its bear market for a while there into October, kind of taking out those lows. Just talking about the 10-year here. And then October, we kind of saw this shifting narrative from the Fed, where now they're talking about, we're going to start decreasing the size of our rate hikes, which is not a pivot or not a pause. It's just, the Fed decreasing their aggressiveness of, destroying demand. So when the Fed starts talking about potentially seeing a decreased size of rate hikes in the near future, the bond market rallied again. And that was, essentially where we're at now, where the yields have peaked for, several months now. Does that kind of make more sense to you, Mitch?
Yeah. So I don't know. I guess it's just something I need to think about more, because you said the Fed there, they sort of made their move after we saw bond yields peak in October. That after that they made the decision like, hey, we're gonna start doing lower rate hikes, and are they sort of reacting to the bond market there, right?
I would kind of say it's more so the
Just
opposite. It's about the bond market is reacting to what they believe the Fed is going to do, and thus far in 2022, they've been fairly spot on, and that's just kind of the thing I was mentioning in the newsletter is that at the moment the narrative from the fixed income market is that we're headed towards recession, and investors, fixed income investors, are looking for protection from that recession. So now it's, if you believe the bond market, which has been, fairly, a fairly good strategy in 2022 and in years past, certainly, you would, believe that there's some sort of recession coming. It's hard to say when, or even with certainty that it is coming. But if like I said, you believe the bond market, you believe it's coming. When it's coming now is the question, and it could be anywhere from, it could, we could technically be in a recession right now. Maybe. I think it's very hard to argue that, but or you could argue that 2024 will be a recessionary year, 2025 will be a recessionary year. I think it's just the timing that's, the real question.
Yeah, that makes sense. And I want to hear your opinion on this, Blake, but I'm surprised they were able to do so many rate hikes, because I remember, this time last year, right before the rate hike started, or right as they were starting, people didn't expect them to be able to do so many before, something in the economy break, before we went into a major recession. So do you have any take as to why they've been able to hike rates so fast, and so far they haven't really shown any. I guess they've shown signs of slowing, but we're not close to any sort of pivot yet.
Yeah, it's an interesting question, and I remember that was sort of the narrative that a lot of people had earlier in 2022, is that the Fed can't even hike rates because debt levels are so high, and I think maybe what a lot of people underestimated was just the ability of people to not care. I mean, we've seen mortgage balances declining. We've seen new mortgage signings declining as well, which is kind of indicative of people caring about higher rates. Obviously, right? No one wants to sign a mortgage with a 7% interest rate or whatever. Um, but we've also seen credit card balances, or revolving consumer credit growing into all time highs here. So maybe I think people kind of underestimated the time that it takes for higher interest rates to truly affect demand. This is something that historically takes a long time, right? It's not like the Fed hikes rates and tomorrow everyone is, not unable to, pay their debts. or insolvent. It takes a lot of time for these things to really affect the economy in general and in the individual consumer. So I think it's certainly something that if rates are going to be held in this territory, in this heightened territory for a long time, then that's eventually going to become something that's, an issue is people unable to, pay their credit card bills or pay their mortgage payments or their car payments or whatever. We're just not quite there yet is kind of the way that I'm looking at it.
Yeah, that makes sense. And when people use the term like debts rolling over, so like as the yield sort of went.
Sorry, my bad, guys. I accidentally clicked the mute everything. Mute
No,
everyone. Go
you're
ahead, Mitch. Sorry.
you're good. You're good, Joe. So like when the 2-year Treasury goes up, for example, that higher rate that's being applied to like the new bonds in the auctions that are happening now, right? And so the old debt that's already been issued still has that lower coupon, correct?
Yeah, I mean that's kind of like the definition of fixed income is the name that the fancier name you like to use for bonds, and I think that kind of displays that well. So the yield that you're looking at, if you open your Trading View or you open Yahoo Finance or whatever, and you can see the yield on the 10-year, for example, or the 2-year example, which is currently about 4.19%. So right now, if you bought the 2-year at that market price, you could yield 4.19% per year on your investment. So, and when you buy that, you're locking in that rate, that yield based on the price, because bonds have a principal that gets repaid in the future. So, depending on where you buy them now, your yield is determined by how much will the price have to appreciate for you to repay your principal, or for you to be repaid your principal. So that's kind of the idea of fixed income investment, is you're locking in that rate based off of the current market price.
Yeah, I think this is a super interesting conversation. I want to add on something that I've thought about, because I think it is interesting, right? Like a lot of people, in my opinion, were wrong over the past year, where they were saying there's no way the Fed can hike rates extremely fast. We're going to be at zero for a very long time. And obviously, over the last few months, that's clearly been proven wrong. But my one caveat, I guess, that I would add is, and I agree with the points that you were making, Blake, as well. But this is another, I think, potential point, is that real rates are still, if you're using, year over year CPI inflation, real rates are still, strongly negative, right? I think if the inflation rate is at 6% and maybe the Fed funds is at 10%, then I think we would have, major issues with just financial markets in general. So I think as long as like real rates are like at zero or even negative like they are now, I think that we can keep skirting along without too much trouble. But I think the moment real rates become pretty clearly like positive, or like significantly positive, then I think that could cause some problems.
Yeah, 100%, Joe. I meant to mention that earlier and lost my train of thought. Rambling on as I do, but yeah, that's a really great point. We can keep talking, CPI macro stuff if you guys want, or if you want to spin it back into Bitcoin. Obviously there's a lot going on there too.
Yeah, we can run it into Bitcoin and then circle back. But one more comment on the real rates. I imagine like markets would behave very differently if they actually showed the real rate of return on bond yields instead of nominally. If you saw that you're getting a negative return, like is that really a good investment? Probably not. But anyways, we can go on to Bitcoin. Obviously, this has been a pretty fun week for price action. So first, like,
Real quick, Mitch,
yeah.
just to add on, I think that was a really interesting point. I think, like, yes, like in the long run, people know that like you can outperform treasuries and like certain fixed income investments like pretty easily, holding something like Bitcoin or like the Nasdaq. But the caveat I would add there is, in the short run, obviously you can significantly outperform Bitcoin and Nasdaq by holding something like treasuries. And so it kind of goes back and forth. But yeah, certainly in the long run, like, the play is Bitcoin. And if you don't know how to time markets, I think like being aggressive, quote unquote, with things like Nasdaq and Bitcoin are obviously the way to go.
For sure. And under under a sound money standard, it would be nice to have, a money when times are very uncertain like this. You want to be able to hold something that you can be confident in, and under a sound money standard, that would be Bitcoin. But we are not quite there yet. Markets are still treating it as a risk asset, even though we understand that it's not. But it has caught a bid this week, which is really good to see. The primary resistance we've been looking at on chain is the short term holder realized price, because if it goes up to that level and then it gets rejected by the resistance, that the short term traders are sort of trying to break even and cash out of the market. But it's not really surprising that it broke resistance this time, because we have been seeing a lot of the speculators leaving the market. It is a bear market, so it's mostly at this point it's just the hodlers that really remain. When you look at, and all these charts are in the newsletter. I should pin that tweet up in the nest real quick. But when you look at past bear markets, typically once the price breaks the short-term holder realized price, that's a good sign that the bottom is in. We'd like to see that again this time around, obviously, but it's not 100% sure. Once we see Bitcoin break the realized price, so realized price is the aggregate cost basis of all Bitcoin on chain. Short-term holder realized price is just that of short-term holders, so Bitcoin that's moved within the last 6 months. But once it breaks realized price, then that's definitely like a really good sign that things are on the up and up. When you look at, yeah, Blake, were you gonna say something?
Yeah, I just wanted to mention, I think is worth noting. Which I think is really interesting, that we're kind of rolling into this environment where we're going to see sort of likely going to see a sort of unprecedented time for Bitcoin, in the sense that, other than 2020, which doesn't really count, Bitcoin's never been through a true recession before. And obviously, like I was rambling on about for the last 30 minutes, we don't know if we're going to see a recession, but the traditional financial markets seem to really think that we're headed towards one. So if we got a more traditional recessionary type environment, maybe not to the extent we saw in '08 or 2000 or 1990, whatever. But if we just saw a traditional recessionary environment, I think it'd be really interesting to see how these on-chain metrics are going to hold up, because like you mentioned, when price comes up towards up through these metrics, it's traditionally marked bottoms, but those also haven't been in recessionary environments. So I think it's going to be really interesting to see overall.
I agree 100%. And something else to think about. I'd be a lot more concerned if this was like 2014, 15, while Bitcoin was still young. Well, we know it's still early. It's definitely become more of a mature asset class, and I think that should give it some resiliency should we go into a recession. And some of the people I've been listening to on the macro, if we do, like, it could be even worse than the previous recessions you mentioned. And I definitely think nothing is certain going forward. These are definitely unprecedented times in the economy and just society as a whole. So it'll definitely be curious to see if these on-chain stuff can hold up through something like a massive recession. Yeah. Anyways, another metric that I looked at was the coin days destroyed. So this basically measures the movement of coins, and it gives extra weight to coins that haven't moved in a long time. And like a massive spike in this basically either signals capitulation or profit taking. Obviously, nobody's really taking profits right now. So we saw a massive spike in coin days destroyed, aligned with the fallout of FTX. And if you have ever looked at that, that classic Wall Street psychology cheat sheet, this sort of is like a massive capitulation. This is what you would expect from the bottom. A lot of people, when FTX happened, they started calling for 12, 13,000 per Bitcoin, and on chain just shows like a massive, temporary fleet, and the last people finally getting out of the market, the final capitulation. We saw a capitulation just similar to this at the bottom of the 2018 bear market. So I think a lot of the all the people who are buying Bitcoin now, they understand that it's not exactly a risk asset. They understand that it's sound money that's absolutely scarce, and that no one can manipulate, and there's no CEO. So I think a lot of the people left are definitely hodlers, and I think the market's cleared out the people that treat Bitcoin as a risk on asset for the most part. When you look at active addresses, basically that's any address that's sent or received Bitcoin on a daily basis, or not on a daily basis, but measured per day. So we saw a pretty decent boost in this over the last couple of days as the price goes up, and that's to be expected, right? You know, when the price goes up, that means people are buying, and when people are buying, they tend to take it off the exchange. So you're going to see more active addresses. But when you look at the 14-day moving average of active addresses, it's held up by a support level of the 4-year moving average. So you don't typically see like we've got this long-term adoption curve, right? And that's the 4-year moving average of active addresses. Over time, more people are on the Bitcoin network, so there's going to be more addresses sending and receiving Bitcoin. And then the 14-day moving average shows, the short-term behavior. During the bull runs, a lot of new people come, they're using the network, massive spikes in the 14-day moving average of active addresses. During the bear market, these two metrics they touch, but you don't really see the 14-day moving average go below the 4-year moving average. And we did see it touch recently, but it bounced off. So it's just something to keep an eye on, and it sort of this metric gives you a good visualization of both the the long-term adoption of Bitcoin, and then also the mania you see in the bull runs, and then the minimal attention you see during the bear markets. And we're certainly in that peak bear market type of scenario. Not a lot of active addresses right now relative to spring of 2021. And then another metric I've been looking at is quell multiple. Joe's pinned that tweet up there in the nest. And basically this measures the US dollar value of the block subsidy relative to the 365-day moving average of that metric. So like if the block subsidy now, I don't know exactly how much it's worth off the top of my head, somewhere around 18 million. But you compare that to the 365-day moving average, it's a lot higher. So you're going to have a really low valuable for the quell multiple. And you see on this chart, I've circled the halvings. So obviously, you're going to see a huge spike because the block subsidy in Bitcoin terms gets cut in half. But what I want you to notice is look just how fast it recovers, right? A few months after, the value of the block subsidy is already back to where it was pre-halving. And I know there's a lot of debate in the Bitcoin community about, whether halvings and the 4-year cycles are just a coincidence. But, we've seen it happen 3 times now. As soon as the halving happens in the months that follow, the price just has to rip up because there's less supply being sold by the miners. And something to think about, we're a mining company, so if we're always sort of viewing things through the perspective of Bitcoin miners. If you can survive that initial drop off in the value of the block subsidy, you're going to be rewarded, right? It's basically saying you got to beat your competition, right? Because the hash rate isn't going to drop off overnight. Some people might drop off overnight with the value of the block subsidy going down, but if you can hold on for a few more months, the price really has to rip beyond where it was before. So that's something to keep an eye on. The 2024 halving is not too far away. It's anticipated for March of 2024. So that's it's literally 14 months from now. Let's think about where we were 14 months ago was the all-time high, and maybe that seems like it was a long time ago, but in reality, 14 months is pretty short in the grand scheme of things. And lastly, I'll talk about the derivatives market real quick. We're at like a really low level in just aggregate futures volume, and I'm sure the collapse of FTX probably definitely played into that. One of the biggest exchanges going bust. A lot of people traded futures on FTX, but just generally speaking, we're at the same level of volume as we were prior to the bull run of late 2020, early 2021. And that's with the price being 2x higher. So that just goes to show like how nasty the sentiment is right now, right? Because the price then was right around 10,000, and now let's say we're right around 20,000, but we have the same amount of futures volume. So that just shows back then when the sentiment's really bullish, you get a lot more traders, people trying to speculate on the market, but they're really scared away by the bearish price action. And if you had to theoretically imagine what the bottom of a bear market would look like, you would think about the scenario we're in now, where it's just the long-term holders remaining, and there's not a lot of people trading futures contracts. and we saw a massive short liquidation relative to long liquidation. Long liquidation. So the metric there is the futures long liquidations dominance. If that goes significantly in the red, you're seeing a lot more shorts being liquidated relative to longs, and we saw the most amount of short liquidations relative to long liquidations over this past week with this little bump up to 19,000. So the bears got wrecked.
Yeah, I've never seen that metric, Mitch, that you have in the newsletter, the futures long liquidations dominance. I think that was very interesting, and it is crazy how I guess over the last week or so or week or two, Bitcoin has had just such a very fast, quick, nice percentage gain, and a lot of people trading it to try to pick up pennies, shorting it in the short term, really did just get pretty wrecked.
For sure, and something just to point out is like this isn't to say that not any longs are getting wrecked, right? Because Bitcoin is still it's a volatile asset, but this just compares shorts to longs. So on a relative basis, there was a ton more shorts that got wrecked, but that's not to say you're safe really taking either side of the trade. And one thing I am kind of surprised about is we didn't see the classic BART on the CPI day, because we saw leading up to it, the price ran up, and I was fully expecting price to go down after the announcement, regardless of where it was at relative to expectations, just because markets can be crazy and irrational sometimes. But so far, we've sustained that price action, and I'm really I like seeing that. It makes me confident in the short to medium term.
Yeah, Mitch, what I think's really interesting and fairly related to what you were just talking about is like these dynamics that you tend to see at the bottom of bear markets. In I'm speaking from an equity perspective, because I think that's kind of the best example and fairly similar type asset to Bitcoin at the moment. But what you tend to see historically is that the retail trader is exhausted at the bottom of a bear market, and you might see these rallies, but eventually you're going to reach a point where the retail trader's essentially given up. So you're going to see a rally, and they're not chomping at the bit to dive back in long. But at that time, that's when the institutional investor is chomping at the bit to get back long, and you'll see these, big green days, high green volume, and that's, in a sense, what we're seeing this week. And to me, it feels like a lot of the sentiment is, this is just, another time to, get out or, maybe take some gains if you've been trading it recently. And it doesn't seem like other rallies that we saw earlier in 2022, where everyone's calling the bottom. People are chomping at the bit to get back long Bitcoin. To me, at least, and let me know if you guys disagree, it doesn't exactly feel like that to me. It doesn't feel like this, mania to get back in because there's a rally in a bear market, which, is not me saying that I think the bottom's in. I just think it's, pretty interesting. And it definitely feels like we're getting closer to that point.
No, that was spot on, Blake, and very well articulated. And the on-chain certainly supports that idea. The traders just have not really jumped on this rally relative to past little increases in the price throughout the bear market. If you look back in points in 2022 when we rallied off of certain price levels, you saw the traders get all over that, but we're not seeing that this time around.
Yeah, it kind of reminds me of almost like 2020, not so close to that extent, but and I've talked about this a million times, but it's like 2022 is a great example of, the market's bottoming on the worst possible news. And now that's not where we're at, obviously. The news is getting better, but 2022 is that kind of environment or 2020 was that kind of environment where it was obviously, based around COVID lockdowns, and, mid-March to late March of 2020 was kind of, peak fear of COVID. And that's exactly when the market bottomed. So then when the market started to rally, you had this sense of disbelief from retail investors. And, it's that old saying that the market, climbs the wall of worry. And I think that's potentially something that we will see, maybe 2023, maybe not 2023, but, whenever that time comes when assets are, truly have bottomed, and are going to begin to, move back into a bull cycle, we're going to see this sense of disbelief or from the retail investor, where they're saying, hey, but look at the macro situation, or look at what's going on in the world, but the market doesn't care, and asset prices are going to bottom when they bottom. I just think it's pretty interesting.
Yeah, totally agree. Have you guys noticed that the price of Bitcoin somewhat feels like it flipped when like we hit January 1st, 2023. Like I'm just looking at a chart right now and it just seems like it's been a slow, like quote unquote small parabolic rise up right when January 1st hit. Do you think there's any, a reason why when the new year happened people would be allocating into Bitcoin, or is that just pure coincidence?
No, Joe, I think it's a great observation, and I think a lot of it just has to do with tax loss selling. So December 28th was the last day for 2022 to sell assets and harvest capital losses to offset any gains and get a tax deduction. So kind of what I was expecting to see, and a lot of people were expecting to see, was after December 2020 or December 28th, we would start to see this rally as all that sell pressure from tax loss selling has been alleviated. And at first, that's not what we saw, right? We saw a few sessions of continued sell-off, which I think was, fairly confusing. I would say I was a little surprised by it because a lot of people were just expecting us to just, start heading higher from there. But it's just kind of what the market does, right? It fakes people out. It never does exactly what you're expecting. That's just how markets operate. But now that we're seeing this rally, I think it makes a lot of sense because, we're now in a new tax year and there's less incentive for you to, sell right now.
That makes a lot. I've never thought about that. Do you see the inverse during bullish years? Do you see less sell pressure because people don't want to have capital gains?
It's a good question. I'm not, exactly sure, but I think, it's part of just the seasonality of the stock market. I'm talking about the stock market here. Obviously, Bitcoin is fairly similar in that sense. Is you have seasonality, you have times of the year that are traditionally better for stocks and traditionally worse for stocks. And the Santa Claus rally is something that a lot of people like to talk about, but you also tend to see in December a lot of sell pressure because people are looking to harvest capital losses. Even in good environments too, you want those losses to offset other gains or just to take the tax deduction. But it's just something that we've traditionally seen in the markets for a long time.
Interesting. And I'll make one more comment, and then Joe, you can take it away with the mining. But I would be very surprised to see a second yearly red candle in Bitcoin. I think it's highly likely that we close above where we closed for 2022. That's not to say it's going to be orders of magnitude greater, but with the Fed already sort of showing signs that they're slowing down, we'll see if they can hold higher for longer. It'll definitely be interesting to see over the next 12 months how that all shakes out in the macro, because that's definitely in the driver's seat at the moment. But with that, Joe, you can take it away with the Bitcoin mining.
Sounds good. Thanks, Mitch. And yeah, I have a similar opinion. I have a hard time seeing Bitcoin close 2023 below 17,000. I mean, granted, if we do go through like a massive recession or some sort of like mini depression, then maybe anything's on the table. But yeah, I don't think, like, macro could certainly get worse, but there's also a decent probability that the bottom is in or close to being in. And so yeah, I tend to agree. I don't think we could go. I think the odds are we go higher than 17K certainly by the end of the year. But yeah, I'll run
Yeah,
into mining. Oh,
one
go
more
ahead.
thing, Joe. I'm sorry. We talk about sort of like the worst case scenario with like going into a recession and how that could negatively affect Bitcoin. But I think we could also see, a really optimistic view is, a lot of these problems in the macros caused by the manipulation of money. And you could see sort of a turning point where people look to Bitcoin and realize that it is, the risk on asset. It would make for a better, sound monetary system. So in something like a massive recession or depression, it's entirely possible that could be the turning point for like massive Bitcoin adoption.
Yeah, I would agree with that. I think it could be like serious short-term pain if we go through like some sort of crazy monetary reset and like the real price of Bitcoin may fall. But yeah, I think massive deflation, massive inflation. I think at the end of the day, Bitcoin is kind of the best money humans are gonna ultimately, agree to use basically. And just because of its unique monetary property. So yeah, I totally agree. I think that it's probably going to happen. It's just I don't know the path to get there. It might be rocky. It might be smooth. We'll find out. To take this into mining, there's basically 4 topics that I put into the Blockware Intelligence newsletter this week. The first one is about the new S19J Pro Plus, and this is actually something that Blockware is now offering to existing clients and the new clients. And it's at a due to all the very unique market dynamics, it's actually at a very attractive price. Um, Basically, Blockware is able to leverage the relationship with Bitmain to get an extremely good price. And a lot of the public miners that took on far too much leverage in 2021, 2022, they're basically forced sellers of these mining rigs, not necessarily the Pro Plus, but related mining rigs. And I think that's kind of really harming the mining rig market, especially right now as people are defaulting on loans and really creditors are being forced to take possession of mining rigs. And there's some of them are trying to sell those mining rigs. Some of them are just owning the mining rigs and attempting to mine, but it's definitely, a lot of forced sellers have been in the Bitcoin mining rig market, over the last 6 months or so. So that new rig is out. In the newsletter, we put kind of a table that shows what's the Bitcoin break-even price for the various Antminer models. So we have like the S9, the S17, the J Pro, the J Pro Plus, and the S19 XP. And in the table, you can just clearly see, okay, like how much more efficient is the S19 XP as far as what would be the Bitcoin break even price for that rig if you're operating at 8 cents per kilowatt hour, and compare that to all of the other models. So it's a very useful chart to kind of get an idea of where you stand as a miner in relation to other miners on the market. The second major topic that I put in the newsletter was how the miner capitulation, according to the hash ribbon metric. So, for those that don't know this, the hash ribbon metric was a really cool, simple metric created by Charles Edwards. And it basically just compares the 30-day moving average of Bitcoin's hash rate with the 60-day moving average of Bitcoin's hash rate. And when the 30-day moving average drops below the 60-day moving average, it's just kind of a clear sign or a significant sign that there's net hash rate coming off the network. Now, this hash rate could be coming off the network for a variety of reasons. It could just be like it could be a rainy season back in China when a lot of China miners had to turn off. It could be for economic reasons, as miners are simply just unprofitable and they're shutting down their operations, or at least turning down or turning off their machines. And typically, when we do experience these miner capitulations, it's really the most inefficient miners that are turning off their machines first. And kind of what this does once the miner capitulation ends is it shows the weakest miners on the network, who were likely, the least profitable or probably unprofitable. Those miners that were selling pretty much all of the Bitcoin they mine are now no longer in the market. So after these capitulations, we see the only miners left in the market are those that have had the more efficient operations and likely are able to hold more of the Bitcoin that they are mining. And this is kind of like a bullish sentiment, as you can clearly see that going forward, there might be less day-to-day sell pressure from total miners, just because we've weeded out the least efficient miners. And so with the hash ribbon metric, going back to that, it's kind of showing that we're about to see the end of this particular quote unquote miner capitulation. And historically, that's been a pretty bullish sign for Bitcoin price action, at least as far as there potentially might not be much more downside. Of course, like we were talking about earlier, if the macro situation somehow gets worse, then anything's on the table. But it's a good sign for a lot of historical Bitcoin charts and Bitcoin data points. The second the third major topic in the newsletter is just continuing to cover Bitcoin energy gravity, which was a report that Blockware put out mid 2022, towards the end of 2022. And it's basically a model that visually shows the relationship between the price of Bitcoin and its cost of production. Now, of course, this is an estimate. It's pretty impossible to know exactly what the average cost of production is for all miners, as miners are running various types of machines. They have different energy sources. They pay different energy prices. They operate in different geographic locations. And so this model is basically an estimate using ant miners, like what's the mean efficiency of rigs that were released in the last 2 years. So what's a modern Bitcoin mining rig, and when you plug that in, what's its break even electricity rate for it to be earning Bitcoin profitably. And so that's what this energy gravity metric is. It's trying to show, okay, when are these miners just raking in money, and when are these miners teetering on the edge of profitability, and when are some of these miners actually turning off. And so this metric now sits at 10 cents, which basically just means a modern Bitcoin ASIC is earning 10 cents for every kilowatt hour of energy gets put into the machine. And for most miners, they're operating profitably at that level, although it's certainly nothing like how it was in 2021 and early 2022, when miners were just raking in money based off the energy that they were putting into their rigs. But historically, when, like, similar to the miner capitulation or hash ribbons metric, when miner margins are this low, it's typically a good time to get into Bitcoin, as the cost of production to produce a Bitcoin is relatively in line with the price. Whereas back in the past, when the cost of production is significantly below the Bitcoin price, there's kind of reason to believe that, okay, markets are relatively efficient. There's probably going to be a lot more hash rate coming on the network, which means there's a lot of investment going into mining instead of spot BTC, and there's a lot of future sell pressure, day-to-day sell pressure from miners just to cover their electricity expenses. So when the cost of production and the price of Bitcoin get pretty out of whack, they tend to eventually come back together, and that's kind of what we saw all throughout 2022. But there is hope for the future, like I said, because now the price and the cost of production are much more in line. The final fourth last topic that I covered in the newsletter was kind of showing this data was from hash rate index and Glassnode, comparing the price of Bitcoin to a base level S19. Uh, and it kind of shows that, okay, both of these prices over the last 2 years or so were fairly in line, tracking with each other. Maybe the S9 had a little bit of time decay on it and a beta relatively close to the price of Bitcoin. But recently, for a lot of the reasons that we talked about, the price of an S19 has kind of dripped below or decoupled somewhat from the price of Bitcoin. And I think a lot of this is because of the forced selling of these Bitcoin mining rigs, an extreme lack of buyers in the mining space, and it's kind of created a pretty unique deal opportunity for people looking to get into the Bitcoin mining industry. And so those are the four major topics for Bitcoin mining. Yeah, let me know if you guys have any other thoughts on that.
Joe, yeah, I think that was great. And I'd been meaning to butt in, but I didn't want to, steal your thunder, and I'm glad I didn't, because that fourth topic is what I think is, personally, is the most interesting, dynamic in the mining space right now. Is that you have all this contagion in the market, you have all this fear in the market. So you've seen this asset, a mining rig. We were talking about this internally with the chart, looking at the original S19. But I think it's interesting that you have this asset that is traditionally, very correlated to the price of Bitcoin, the actual price of the rig, the market price, which is, historically very correlated to the price of Bitcoin. And now you've seen over the last, month or so that Bitcoin's gone sideways, and the price of this asset's, continued to go down. And I think, like you mentioned, it's created this really great opportunity, to get involved in the mining space, especially if you're looking at, hash ribbons, and you think that, this capitulatory event might be near its end. It seems like an incredible time to, be buying some miners. Would you agree?
Yeah, definitely. And another thought is, in 2021 and maybe late 2020, we saw literally billions of dollars of capital flow into the Bitcoin mining space because, like I was talking about, the price of Bitcoin was so far above the cost of production. Now we have all of those people that were deploying, and those are like smart institutional investors, right? They were deploying significant amounts of money into the Bitcoin mining industry, even as forms of debt. Like we saw companies like Core Scientific and Argo Blockchain take out massive loans. Bloomberg has covered that billions of dollars of loans were used to basically buy Bitcoin mining rigs. The people that are selling these mining rigs aren't the people that necessarily are bearish on Bitcoin. They're forced sellers at this point. They literally have tens of thousands of mining rigs, and they simply borrowed too much money at a very high interest rate, expecting the price of Bitcoin to not crash like it did, and expecting difficulty to potentially rise slower, and it ended up and energy prices to not rise. And it ended up kind of being the perfect storm to wreck a lot of the over leveraged large players in the industry. And I think because of all those three, catastrophic scenarios playing out all at the same time, it's basically scared a lot of the larger players from coming back into the space at the moment. And so there's a lot of currently large players selling, but there's not many people buying per se, especially at the scale that they're selling at. And I think that's exactly right, and that's why we've seen the price of mining rigs and the price of Bitcoin somewhat decouple over the last few months.
We could be looking at because those leveraged miners, right? It's multiplying your returns while also multiplying your risk. If we saw Bitcoin rip up to 100, 200K, Core Scientific would look like a genius. But because things didn't turn out that way, it put them in a really, really sticky situation. And just a point to really reiterate here is that there's this lagged effect with hash rate. And you guys, you hit the nail on the head with this. When the price goes up, that's when people are like, oh, now I should be mining. But the people who are winning are the people who are already mining before. And the people who the price went up and then they started investing in mining, by the time they were able to really get a large amount of hash online, the price had mostly cooled off. And so when you think about it like that, right now is the time to be investing in mining, because it's absolutely it's miserable out there. The margins have been really cut razor thin. If you're investing now and you can get hash online before the price rips up, you're really going to be able to arbitrage that difference between the market price and the cost of production. And one more point there is, we talked about the halving earlier. Bitcoin just gets programmed and to become exponentially more difficult to produce over time. So the earlier you can get in is the better, because you want to be mining now before that block subsidy gets cut in half. You'll still make, like we talked about, the months after the halving, the dollar value of Bitcoin goes up. But if you want to, accumulate as much Bitcoin as possible, definitely start mining sooner rather than later.
Yeah, very well said, Mitch. I think you made some fantastic points. I mean, I think pretty much all of us on stage would agree that if you have a decent time horizon, you're not trying to time the market and what's going to happen in the next 6 months or even the next year. But if you take a 2, 3, 4 year time horizon, buying into Bitcoin and buying into Bitcoin mining, it seems like a pretty fantastic opportunity.
Yeah, I mean, and shameless Blockware plug here, but I know we have some deals on rigs right now in the Pro Plus right now that are not expected to be able to stay on too much longer. It seems like this point in the market is kind of the ideal opportunity to get involved in mining.
And you made this point earlier, but like the retail getting scared away during the bottom of the bear market, but that's when the institutions are buying. So if they're buying right now, then it's probably a good sign. And we've seen decent amount of investment from some of these mining companies building out facilities right now. So definitely a good time to get into the game.
Yeah, Mitch, that's spot on. And I think it's really interesting how that dynamic plays out in the mining space specifically, because what you see is during the bull market, you're going to get all sorts of new investors wanting to get involved in the mining space. That's when you're going to bring on all these new people who have never been exposed to mining before. And then in the bear market, you get all this fear, and people are now scared to get involved in the mining space, and people who are not already involved likely aren't getting involved at that time. But what you do see during the bear market is people who are already involved and understand the industry and understand their machines are now doubling down on their investment, and they understand that now is really the time to get in instead of waiting for price to start heading back up.
Yeah, another thing I wanted to to quickly add on, we just did a podcast with Dan Roberts, who's the co-CEO and co-founder of Iris Energy, one of the largest Bitcoin mining companies. And he was talking about exactly what Mitch kind of pointed out earlier is there's this clear lag between amount of hash rate that's coming online and the price. So if the price rips up 10x, it's very difficult to it's going to be very slow to see hash rate go 10x. Like that's probably not going to happen anytime soon. And it used to happen in the past because for hash rate to multiply pretty significantly, it just all you had to do was get the next ASIC, and the next ASIC would be 10x more powerful than the previous one. So it used to be all about just deploying and buying the newest machine, but now the game has kind of changed, and the lag between price and hash rate is becoming more pronounced because it's not necessarily a matter of upgrading to the newest ASIC, but it's more about building out the energy infrastructure and the mining infrastructure to be able to plug more ASICs in. Yes, of course, like the newer generation ASICs are going to give you an edge as far as like more more operating profitability and kind of give you more downside protection. But for hash rate to double or quadruple, if price does that, it's definitely not going to happen overnight because that's literally gigawatts worth of energy that are going to have to come online for the Bitcoin mining network. And gigawatts are a significant amount of power. But yeah, I think that's it. Any final thoughts from you guys, and we can go ahead and wrap it up, I guess.
No, nothing really. Nothing more than what's already been said. Remember, market's not open on Monday. Of course, Bitcoin never closes, but your traditional markets will be closed on Monday for MLK Day. But just wanted to thank everyone for listening and hope everyone has a great weekend.
Awesome. And I want one more comment, just because I think this might be the first space we haven't said, not your keys, not your coin. So I just wanted to throw that out there as a gentle reminder. Not your keys, not your Bitcoin. So thank you, everybody, for listening.
Totally. Thanks, Mitch. Thanks, Blake. And see you, everybody.
Yep. Later, guys.